Hey, everybody. Today we're going to be talking about the Federal Reserve rate. The FOMC had their rate hike meeting yesterday. They have 8 of those a year. And a lot of people have been talking about the federal interest rate, and a lot of people still don't know what it is. I'm relatively new to all this stuff, but it interests me a lot, and I just wanted to help share some of the knowledge that I've learned over the last few years. All right. So, what is the federal funds rate? That's what the federal interest rate, the rate hikes that you always hear about, it's usually talking about this. Now, the federal funds rate is the interest rate that banks charge each other to borrow or lend excess reserves overnight. Law requires that banks must have a minimum reserve level in proportion to their deposits. This reserve requirement is held at the Federal Reserve Bank. When a bank has excess reserve requirements, it may lend these funds overnight to other banks that have realized a reserve deficit. So, what this is saying is at the end of every day, banks are supposed to have a certain amount of money in the bank just in case everyone decides they want to go get all of their money out of the bank the next day. Sometimes they have a shortfall on that because they lent too much money, so they borrow that amount of money from another bank. That bank that lends the money earns a small amount of interest on it. The bank that borrows that money pays it. How is this rate determined? It is customary for the FOMC, Federal Open Market Committee, to meet 8 times annually to determine the federal funds rate. So the FOMC meets and they decide, based on the current economic conditions, where they want to move the rate to. Now, why is this important? All right. The Fed funds rate is basically the cost of banks to borrow. All right. And all of the other interest rates are set on top of that rate. So, what do I mean by that? It has a ripple effect. This is all I love Investopedia. If you guys have any macro or microeconomic questions about something or a topic, I would check on Investopedia. Uh, when the Federal Reserve makes it more expensive for banks to borrow by targeting a higher federal funds rate, the banks in turn pass higher costs onto the customers. Interest rates on consumer borrowing, including mortgage rates, tend to go up. Short-term interest rates go up. Long-term interest rates also tend to rise. As this happens, the interest rate on the 10-year Treasury bond moves up, and mortgage rates also tend to rise. So that house that you want to buy, when you have a 3% mortgage rate, this is the 30-year fixed rate mortgage rate chart. When you have a mortgage rate of 2.5%, 3%, you can afford to buy a lot more than you can when you have a mortgage rate of 5%, like this chart shows. So back in 2020, when they lowered rates to zero, the cost of a 30-year fixed rate mortgage, the interest rate on that was 3.5%, and it eventually bottomed out at below 3%, 2.5%. All right. Now that the Fed is raising interest rates from 0% to now 0.75 basis points, the cost of borrowing for a 30-year fixed rate mortgage is all the way up at 5.27%. That's just one of the things that the interest rate affects. Now let's go to a chart of the NASDAQ. So this is when all of the talks about tightening federal monetary policy, i.e., raising interest rates, started. And this is where we are now. So we are down 23, 24, at most, about 25% at most, off of a interest rate hike from 0 to 0.75%. Let's go to another chart. So let's also talk. I want to talk about Netflix specifically too. So Netflix is a big part of the Nasdaq, and it is down year to date 70%, 75%, give or take. what I'm saying is these stocks are priced to perfection. When they miss their earnings, even by a little bit, or interest rates rise, the capital flight from these unsafe risk assets move into something like a treasury. 10-year treasury rate was bottomed out at 0.52%. This means you're lending your money to the government for 10 years and earning a 0.59% interest rate on it. We are now approaching levels, after raising the interest rate to 0.775 basis points, approaching levels 3.5%. We have not seen these levels in nearly 5 years, or in nearly 3 years, after just 75 basis point rate hike. So let's go over it again. What are the implications? Risk assets will fall. NASDAQ, Bitcoin, and other stocks correlated to the NASDAQ until the Fed policy reverses. So why are they doing this? If the stock market is currently crashing and there's all these negative effects, why are they raising rates? It's to manage inflation. So let's go over to the CPI. So this is the consumer price inflation chart. And because the Fed has made monetary policy so loose, lowered interest rates so much, people were able to borrow money more easily. In doing so, in lending out all of this money, there was more money added to the system. All right. When there's more money added to the system, the rate or the prices of hard assets like real estate and stocks tend to go up. That's why we saw the big stock market boom after the pandemic, because they pumped all that money into the system by making the cost of borrowing artificially low. So now, on the flip side, now that we're starting to tighten monetary policy, the prices of those assets are starting to fall. But we pump so much money into the system that the other hard assets, the consumer goods, gasoline, energy, food, other commodities, new vehicles, all them listed here, have gone up dramatically. And now the Fed puts CPI at 8.5% year over year. But you and I all know that the price of gas for me has nearly doubled. The price of food is probably 50% higher. Price of energy to heat a home is 30% higher. I'd say the real number for me personally, everything that I'm paying for compared to last year is probably closer to 30% more expensive. Depending on where you are in the country, that could be even more. And this is a whole nother video why this rate is kind of cooked. But 8.5% year over year, it's still much, much higher, way higher than we've had in the last 20 years. So they're raising rates to try and keep that under control. Now, is it that simple? No, but kinda. So at the same time as you're raising these rates, people are selling off all these stocks and moving into quote unquote less risky assets. The 10-year, like treasuries, the 10-year treasury rate is now, from its low of less than 2.7%, all the way back up at 5.27%. More money is going to end up getting dumped into treasuries and taken out of the stock market the higher rates go. The question is, how much can the Fed do this before they break stock market, real estate market, some market that just cannot handle the amount of capital flight out of that market and into things like US treasuries? Because imagine right now, if instead of having to buy a stock from the NASDAQ, which has crashed 25% in 3 months, you can just go buy a 30-year fixed rate treasury at 12.5%. All of a sudden, it makes a lot less sense to go and buy something as risky as the NASDAQ, where you have companies like Netflix dropping 75% in 5 months. So, in conclusion, What will happen if the Fed raises its rates to 3.5% like they say they want to? Well, I don't know. 3.5% is 5 times higher than the current rate of 0.75%. Can the markets really handle that? You tell me. Thanks for watching.